All right, how's it going, everyone? My name is Amos, and welcome to another episode of the Weekly Earnings, where we'll be going over the call-outs from last week, and we'll also be looking at the road ahead. And as you can see on your screen right now, this is what it's going to be looking like for the rest of the week. If that's all you care about, I'll talk to you next time. However, if you stick around, we're going to be doing a deep dive into last week's call-outs now. And first up, I wanted to talk about Aon, the HVAC company. Well, they reported their earnings and it wasn't pretty. They missed their revenue and bottom line expectations, and they sold off when that happened past 5 days. Look at that. They dropped to about $62 a share. I know right here doesn't show you that, but intraday trading, they went all the way down to $62, as you can see right there, their 1 year metric. Lowest price in the past 1 year, 62. Highest price is 144. So they've fallen quite far from their highs. And it's because their earnings was a pretty bad situation. So their margins decreased. Their new ERP system rollout in Texas absolutely bottlenecked their operations and their production output. And their full year guidance also got cut. However, with all that said, their data center line of business is still a very shiny diamond in a very poopy earnings. Now, a fun fact about Aon is that they were featured in my HVAC industry breakdown and rankings video. So this is a company that I think very highly of. And the sad thing is, I actually had buy orders placed for about $74 a share. And I'm not sure what happened, but last week it didn't trigger. When it dropped all the way down to 62, I was like, okay, I expected the next morning to open up my brokerage app and be like, okay, now I'm a shareholder of Aon, but it just didn't happen. Now, with that said, I would still like to own the company. I think I'm going to adjust and modify my buy order from $74 to now $63 because if it's as volatile as that, where it can swing up and down, I would rather want to buy it at its lower price point. And by the way, if you can't tell, the earnings weekly video series, it's more of a laid back kind of a thing, right? Think of it as like a podcast or a couple guys just drinking a beer or sipping on some green tea and just talking about the stock market, okay? So it's not going to have the greatest production value. But anyways, moving on, the other company that I want to talk about is Big Bear AI. I think in the speculative traders world, I think Big Bear was probably the biggest headline of last week. And as you can see, this is a company where even just a year ago, they used to be about $1.20 a share. And then, I guess in February, they reached a very high of $10 a share. And now they're at $6.14. If we zoom back to 5 days, they were about $7.38. And after they posted their earnings, they just went on a massive sell-off. It was pretty drastic. And I think I understand why there's so much, or I guess so many investors and traders interested in this company, because there's a lot of hype and speculation that they want them to be the next Palantir. But the thing is, when you look at Palantir, right? Let me just pull them right here. Ticker symbol PLTR. And we check out their financials. This is a very beautiful picture from the beginning, from 2018, all the way to right now. Their revenue has consistently been growing at a double-digit rate, correct? Now, if we zoom back and we take a look at Big Bear and take a look at their financials, as you can see, their revenue has been growing at a double-digit rate up until 2022, and now it's pretty sluggish. And if you look at it visually, I think it paints a more clear picture. It's pretty much flat. I mean, yes, it is going from about 145 million to 152, but for a company that's being hyped up to be the next Palantir, those are not exactly the numbers that back up that kind of title and label. And Palantir, in the past 10 years, they didn't have an earnings report this bad. So what exactly happened and why did Big Bear go on such a steep sell-off? Well, their revenue was down by 18% year over year. Their earnings per share, also known as the bottom line, was negative 71 cents. So if we scroll down here and you check out the EPS, right now on trailing 12 months, congregate, it is $1.62 in the red. This is an unprofitable company. And what's crazy about that is it's a software as a service type of business. They're not out here manufacturing and producing cars, phones, or shoes. To be unprofitable as a software business, I think for me, that's a pretty big red flag. And the worst part about their earnings is that the leadership team made the difficult decision to cut and slash their guidance for the rest of the year. So with that, I'm officially going to be deleting Big Bear from my watch list. I'm no longer interested because number one, they're unprofitable. Number two, I just don't see them being the next Palantir at this point. Because with all of the hype surrounding this company, to be only growing their top line at a rate of 3% in a bull market year over year, that's just, I'm not even trying to sound too harsh here, but that's just not good enough. I'm not interested in them at this point. Because if you invest into Big Bear, I think it's pure speculation that they are going to be a 10-bagger, which I don't see any proof or data that backs up that claim. I think back in 2020, or even, hold on, let me zoom out because we can't really see. There it is, 29. I think back in 2019 and 2020, I think that claim would have had more punch to it. But in 2023, 2024, and 2025, to be growing at a number that's a low single digit year over year, not my cup of tea, friends and family. And what's funny is, last week, just for entertainment purposes, I said, hey, after they post their earnings, Big Bear, they were either going to balloon up to $9 a share or drop to $4.50. Absolutely no in between. And the crazy thing is, when you consider the intraday low price, they actually reached $4.75 a share after their earnings. So I was pretty darn close, but I was off by 25 cents. So that's Big Bear AI, and because I'm deleting them from the watch list, now it opens up room for another company to take their spot. But anyways, another company that reported their earnings last week is Cisco, the old school tech company. And they absolutely crushed the top and bottom line because their network infrastructure is a critical piece of the pie to the AI movement. And year to date, just by share price appreciation, they're up by 11.8%. But something that I do want to call out about Cisco is if you did buy into them during the .com bubble crash at about, what's that highest point? Okay, there we go, $77, you would still be in the red. However, if you did buy into them during their IPO, all time, they're up by 80,000%. But if you did buy into them after the .com bubble crash at about like $15 a share, like right here, I think you would be a pretty happy guy. Past 5 years, they're up by 55%, and they do pay a dividend at 2.4%, 62% dividend payout ratio for a tech company. It's pretty good. Now, as a backstory, Cisco is a company that I am pretty familiar with because during my MBA recruiting journey, it's one of the companies that offered me a full-time job. And to get that offer, as you can imagine, I had to do a ton of prep work for the interviews and networking with the people that are currently in the company. And last time I checked, I think like 2 or 3 years ago on LinkedIn, all of them are still at Cisco. I think Cisco is one of those companies where once you join the company, you don't really jump ship because they treat their workers well. The compensation packages are pretty generous, and the work-life balance for being a tech company is pretty solid. Because from my understanding of my friends that joined startups, dude, most of them lost all of their hair. Absolutely stressful, 80 to 90 hours a week, and your compensation is basically tied up in RSUs, basically a stock-based compensation package. Whereas Cisco is one of those more ancient companies where their products, they only have to refine it and make tiny little revisions and upgrades here and there, and that's it, right? Like their IT and Wi-Fi and everything else that they do is so well made and produced and has such a wide economic moat that they don't really have to be stressing out every day or every week. And looking back, I kind of do regret turning them down, but it is what it is. I think having line of sight into their business operations and as a company, it gave me the confidence to buy into them. And that's why I'm an investor of Cisco even today. And since I bought into them, it's been a pretty good performer in the portfolio. I can't say that it's in the top 10, but they're definitely up there. And it's one of those companies that I really wish I would have bought more shares of. So I remember the narrative at the time when I was buying into them. I think it was like some point like right here. There was a lot of speculation like, oh, Cisco, they're old news. Dude, they're a one-trick pony. They're going to be bankrupt by the end of the year. And I kept thinking like, that can't be true. From my understanding, their economic moat is basically being so sticky with their customer base, but also high switching costs. You can't just switch to one of their competitors without having a huge setback in your operations. Understanding that, and their sales team is super aggressive, I was like, I'm going to invest into them. And it turns out that I was right. And it's been a pretty good company to invest into. I think as of right now, though, at $66 a share at this price point, I would not dollar cost average. I think they're trading for a pretty darn cute premium at about a 25 PE ratio. But if Cisco does drop down to like 50 or even 45 bucks a share, I think for me, easy buy. And then the last company that I want to talk about from last week is Flowers Foods, ticker symbol FLOW. This is one of those food CPG stocks that is struggling right now, but it's not unique just to them. Everybody in their category is also struggling. Conagra Brands, General Mills, Hormel, you name it, they're all struggling. Year to date, down by negative 24%. And their earnings, it wasn't really pretty, but I can't sit here and exaggerate and say that it was ugly either. Their revenue was up by 1.5% year over year, and they beat the EPS expectations. However, the reason why their stock went on a 5% dip after reporting is because their guidance for the future was very cautious. They weren't optimistic, they weren't bullish, and they kept saying like, man, I think the consumers are pulling back from spending on bread. And that's all they basically do, right? I think they also have bakery products outside like tortillas and English muffins, but bread is their main bread and butter. But anyways, it's a CPG stock that I do have a handful of shares of. But at this point, I'm going to hold. I'm not going to sell. Nothing in the report, their earnings, was worthy of me panic selling and saying, oh, their fundamentals are gone. I think as of right now, I think Flowers Foods is still decent. Now, are they growing at a very aggressive pace? No. But I think it's one of those like really stable, tried and true, and I think this is just like their rough year. And as you can see, like their company history, they're up by 636%, and this is their steep decline and sell-off. They saw this happen once ago back in 2015, so this is something they've experienced in the past, and they navigated and they did okay as well. And then during the financial crisis, they went on a massive sell-off. So I think buying them right now and holding on to them, I think for me, it makes sense. But it's not something that I would go gung-ho and sell everything to go 100% into. I think Flowers Foods, I only have a handful of shares. I don't plan on selling. And now, if we take a look at the week ahead, this upcoming week, as you can see on your screen, I would argue the retail heavyweights are reporting. We got Target, we got Walmart, BJ's, Home Depot, and then, of course, Ross Dress for Less, and then their competitor, TJ Maxx. And then, if you stay watching, we'll continue to look at each day to see if there's anything else that this calendar is missing. All right, so check it out. Monday, August the 18th. By the way, I don't know what it is with me today, but I am not able to speak clearly. I keep fumbling on my words and I keep messing up my train of thought. I don't know what's going on. I'm in good spirits. I'm in a good mood. It's just, man, I am out of it. But anyways, on Monday, I think the only one that the market is going to care about is Palo Alto Networks. And I think this is one of those Nancy Pelosi companies where if you didn't buy into, wait, what? I guess the opportunity is here again. I think when it was revealed that she was in this company, I think it was like right here, 70 some odd bucks. And then it just skyrocketed, but they are on a pullback right now. But would I want to buy into them at 100 PE? No, there's other opportunities in the stock market at a better deal. That is a major call out. What is their market cap? It's $100 billion. That's crazy, bro. Wow, the expectation for their EPS is to drop by negative 3.9%. That's odd. Yeah, so Monday seems pretty quiet. Let's jump on over to Tuesday. Dude, this is a pretty mild earnings recap, or I guess earnings week, because like episode 3 or 4, like 3-4 weeks ago, dude, there was like 200, 300 companies reporting on each day. This one is going to be a lot more digestible. Home Depot, Medtronic. I really like Medtronic. As a matter of fact, when I used to work at one of the biggest pharmaceutical companies, we also had a medical devices line of business, and we would always look at Medtronic as our biggest peer and competitor. And because of that, I learned about Medtronic, and it's a really solid company. And yeah, they don't really grow at an explosive rate, but it's slowly growing. Steady, reliable, and they basically make medical devices for people with illnesses, or to help them with their heart, etc. And I think that's not going to go away anytime soon, right? So this is a company that I do like, but to buy into them, not at this price point. I think for me to consider buying into Medtronic, it would have to be around $65, $60 a share, which in the past 1 year, it didn't happen, and I don't think it's going to happen. So we have Toll Brothers, the home building company. By the way, if you're in the home building industry, how are things going right now? Because it looks like we are still growing, right? It's up by 1.5% year over year. Take a look at their stock performance right here. Yeah, I mean, it seems like as an investment, Toll Brothers is still chugging right along. But I don't know too much about the space for me to feel comfortable about investing into Toll Brothers or any one of the other home building stocks. So if you're involved in that space, construction or whatever, let me know. It's something that I would be interested in. And then Wednesday, there's 27 companies. There's TJ Maxx. There's Lowe's. Oh, there's Lowe's and Home Depot. How clever is that? Target. Wow. Target is reporting on Wednesday. So Target's a company that I used to be invested into. I sold out of them earlier this year at about $120 a share. And ever since their sell-off, I've been looking for a re-entry point to get back in. And I guess I did get that opportunity back in April, when they reached about $87, but I didn't pull the trigger because back in April, dude, I was so busy buying up so many different companies. And I think Target was just they were way down the list of priorities. And for me, depending on how their earnings go, I feel like it's going to be bad. You can quote me on that. I think it's not going to be good. So if they do go on an unjustified emotional sell-off, I'm buying in. Personally, if they reach $90 or below, I'm going to start dollar cost averaging. It's a company that I've been trying to buy into, and I think this might be my opportunity. The reason why I say that is, I think up until this point, we didn't really feel the ramifications of tariffs, right? But I think this will be the first quarter where we're really going to see how much of an impact tariffs had on the retailers like Target and Walmart. So for me, I would love to buy into Target this week, unless something fundamentally changed with them, like, hey, we're going to leave the consumer discretionary industry and we're going to start doing, start selling used cars. Obviously, I'm not going to buy into them. As long as their business model is still intact and they missed their earnings and revenue by a small percentage, I'm in. And then there's wait, is this the Korean grocery chain? Let me just investigate. No, this is a hotel company based in China. China, as they say. Anything else that's crazy on Wednesday? They got that. See, this is one of those dividend stocks where I'm not really a fan of. The Zim shipping, check it out. Dividend yield is 43%. I think there's some people that love them, but for me, I just don't see the appeal. I would rather invest into yield max ETFs than go with Zim. And I think other than that, wow, this is a really easy earnings video. I guess in the first 15 minutes, I was stumbling on my words, but I think now my brain is starting to wake up. It's early in the morning here in Japan. It's Monday, so by the time you guys watch this, maybe it'll be Monday as well. I don't think this week in the stock market's going to be too crazy. There's Walmart. See, Walmart is kind of interesting because they're copying the Amazon playbook, because initially Amazon was the one that had the imposter syndrome and they were taking the Walmart playbook one for one. But now it's Walmart that's copying Amazon, because I think the biggest growth driver for Walmart right now is their ads line of business. I think they're learning from Amazon that selling ads on your TVs in the store, like in the TV section, plus on your website and everything, dude, it prints cash. And advertising it's an industry that I really like. And that's how Google, I guess my employer, the platform that you're watching this on, that's how they generate money as well. And speaking of advertisements, I know this company they're not reporting this week, but the Trade Desk, they primarily do advertisements on platforms and mediums outside of YouTube, Facebook, and Amazon. So everything else, that's primarily the person that you go to get your advertisements posted. And right now, dude, I think Trade Desk, it might be a buying opportunity. This is a company that I've been eyeballing, looking at their financials and everything. And I'm like, dude, everything looks pretty darn good. You look at their earnings per share, 62% improvement year over year, 83 cents a share. You look at their free cash flow, they're flush in cash. I think the only thing that's holding me back is the rest of Wall Street is absolutely bearish towards them. So I'm like, so the sentiment is negative, even though the business operations look pretty darn sound. I'm on their balance sheet right now. The cash that they have on hand is $1.6 billion. And when you compare that to the total debt, they have $340 million. So after they pay off all of the loans on the books, they still have $1.3 billion of cash left over. So this is a cash-heavy company. They can absolutely afford to pay a dividend, which I don't know why they're not. So the Trade Desk, it's a company that's on my radar, and I'm contemplating whether or not I want to buy into them. I think the only thing I think a second factor that's holding me back is their PE is a 62, which seems a little high, doesn't it? I mean, I know their forward PE is a 27, but I guess for the numbers that they're posting, I mean, this is really amazing, right? And that's why the advertising business segment, I'm a huge fan of. I think till the end of time, I don't think advertisements, commercials, billboard ads, I don't think they're going to go away, because marketing is here today and it's going to be here tomorrow. So I don't know why we started talking about them from Walmart, but hey, if you're interested in Zoom, dude, I don't know what the investing thesis is anymore, because I feel like a lot of people are now utilizing Google's video platform plus the Microsoft Teams function to do video chats. I think Zoom, I'm kind of bearish towards. I wouldn't want to invest into them. And then also on, Thursday, there's Ross Stores. This is a company that I did a deep dive on not too long ago, because one of you guys, you were commenting on every video that I was uploading with, can you please look into Ross? And then I finally looked into them, and I think they're okay. Like on a grading scale, like a 6 out of 10. Not a company that makes me salivate and say I need to go out of my way to buy into them. And even if they go on a dip, also not a company that I want to buy into. So they're not on my watch list, but they are sound. Like their financials and fundamentals, it looks good. Anything else on Thursday? Dude, this is such an easy earnings week. My goodness. But Friday, there's 24. Oh, sorry. Friday, there's 48. Oh, there's Unilever. Yeah, if Unilever, speaking of European stocks, I don't really talk about it too much, but I think Unilever would be right up there for me. If I had to buy a European stock, ASML, yes, not Spotify. I don't believe in Spotify's future or economic mode because whatever they do, YouTube can do better. Podcasts, music, playlists. I think YouTube has the upper hand there. I think Spotify just has all of the momentum and trend. They're the it girl right now. Like everybody wants to be them. But I think once their popularity fades, I think YouTube is where people will flock back towards. But Unilever for me would be a buy. Not Spotify. I know that's a hot take. I see Unilever as like a Procter & Gamble equivalent, but based in Europe. And let me see if there's anything else I think that's about it, folks. I think this is going to be a pretty mild week in the stock market unless, there's tariff announcements or trade deals that go south. I don't think this is going to be too crazy volatile of a week. But anyways, last week, I think I told you guys I had my first dental cleaning. I haven't had one in years, right? In the longest time, I haven't gone, but my wife's insurance plan had to hook up, and so we got it done. And dude, leading up to that appointment, I was so freaking nervous and anxious. So I kept thinking to myself, like, dude, what if I have a cavity? If I have a cavity, they're going to have to drill and yank out a tooth. I'm so scared. But come to find out, during my appointment, the dental technician, I guess the hygienist, and the dentist himself, they looked at my teeth and they were like, dude, you're doing a really good job. Because after the x-rays and everything, they said there's no cavities, there's no problems at all, and they barely spent any time cleaning between my teeth. So I was just like, wow, that took me by surprise because I kept thinking like, dude, they're going to yank a tooth. But man, what a relief. I feel like on that day, I worried myself sick because I felt so off that day because I was sweating. As I was sitting in the lobby room with the AC blasting on my face, I was still sweating. I was so scared. But yeah, I guess I just don't really have good experiences with going to the dentist growing up. But hey, now that's over. I'm pretty stoked. And I guess as a recap of last week, any portfolio changes, obviously I'm going to be launching, that weekly series where I talk about it in a dedicated manner and fashion. But the only thing I ended up buying last week were the Yield Max ETFs, Alti and Misty. I was hoping that I bought into Aeon, but it just didn't happen. And you know what? I think after making this video, I'm going to hammer out the details because I want to do the public portfolio updates, transactions. I'm thinking about selling this type of series, and I got to get that up and rolling, especially before the kid is born. With all that said, I just want to say that I'm feeling really encouraged by all of the love and support you guys have been showing the channel. Because for the longest time, I'm not exaggerating. Whenever I would upload a video, I would be lucky to get 300, 500 views. But consistently and reliably, you guys have pulled through. For the past 2 to 3 months, every single video that I upload hits at least 1,000. And it honestly makes me want to go even harder and keep putting out more content for you guys because it's like, wait, hold on, there's 1,000 people around the world that are watching my content. Dude, that's sick, right? Like I'm nowhere near some of the bigger YouTube channels that gets 50 to 100,000 views per upload, right? I'm still at 1,000, but dude, I'm stoked. And I guess some other updates. We gained 2 Patreon members this past week, which I guess speaks volumes. I guess more views means more people being exposed to the content. And I guess the community on Patreon is growing, but we also lost 1 member. So I guess you gain some and you lose some. But still, I just want to give you a dedicated shout out. If you're a part of the Patreon, oh, there's my dogs. I guess the mailman is here. But anyways, if you're a part of the Patreon, I just want to say thank you because every bit of support makes a difference, right? This is my full-time gig, full-time job. My part-time job, by the way, is going to be ramping back up here in the next few weeks. So I'll be going and earning a normal paycheck from that mode. But I don't know. If I'm going to be making minimum wage, I might as well do it my own way, right? Through YouTube. And the fact that we're growing at the pace that we are, it gives me hope and it motivates the heck out of me. And I guess I want to circle back to that public portfolio weekly series thing. One thing that I'm going back and forth on is whether or not I want to implement a voting system, meaning like, hey, these are the 2 stocks that I'm contemplating. Which one should I buy based on you guys voting? But I guess one thing that's holding me back, I hesitate because what if it's a stock that I'm not really in love with, but it's a trending stock and that's why I have it featured in the video, So it's like, maybe I should just share with you the portfolio holdings based on my reasoning, rationale, and strategy rather than having a voting system by the people. I feel like that would be a fun video series, but dude, what if everybody's like, dude, you should buy into insert very speculative company. I don't know. Let's think of one together right off the top of my head. I don't know, like Big Bear AI. Hey, Mose, why don't you put all of your money into Big Bear? And everyone starts voting yes on that and end up losing a crap ton of money. Like, yes, you would get the views, but I feel like I would be selling out because I don't believe in Big Bear. And so to go big into that, I guess I answered my own question. But anyways, I love you guys. Stay safe. Good luck in the stock market this week. And I'll talk to you guys really soon. And speaking of really soon, I'm currently working on a video right now where I'm analyzing and I'm crunching numbers. Been working on it for the past 72 hours. I'm trying to figure out what the best income ETF is. And I'm looking at all of the big names out there. I feel like that video is going to do pretty well. So that's going to be the next upload. Anyways, see you guys. Peace.